just going to talk about taxable income and how our income tax is actually calculated, like our personal income tax. Now, personal income tax is the money that comes out of our income. It's usually each weekly. It's usually fortnightly. Sometimes people get paid monthly. It depends on how you get paid, if it's weekly, fortnightly or monthly. And this money will go to the government, and then the government uses the money to buy different things, like, might have like a playground, or might have different facilities that are for the community, like parks and sporting fields, etc. Okay, so then so that's how your tax is actually taken out. How your tax is actually calculated, that's what we're interested in here. So the first thing that when you're looking at calculating your tax, you have to work out your total income. Now, your total income is called your gross income. And your gross income is the total income that you have made for a financial year. So a financial year, it's not like a normal calendar year. It's from the 1st of July to the 31st of June the next year. And at the end of the 31st of June, everyone puts in what's called a tax return. And from that tax return, you work out how much tax you did actually pay, and you work out how much tax you should pay. And from this, you can then work out whether you get a refund if you've paid too much tax, or you'll end up with a tax that you owe. Now, how this happens, basically, is the first thing when you're working out your tax income, the first thing that you have to do is work out what's called your taxable income. Now, your gross income, your taxable income comes from getting your gross income. Your gross income is, I'll just put taxable income. So you've got to work out your taxable income, because once you work out your taxable income, that's the income that's going to be taxed, then you can use the tax table to actually calculate the tax you owe. Your gross income is your total income. Now, your income could come from things like, your salary. You could have other ways you're earning income as well. Maybe from interest in a bank. Maybe you've got shares and you're earning dividends from your shares. But what you do is, once you've worked out that, you work out your total tax deductions. And your total tax deductions, what they come from, they are your work-related expenses. So what does that mean, work-related expenses? Well, that's actually the money you spend. You spend to make your income. Like at the moment, I'm using my iPad and my iPad pen, and I use them to make videos, and I do that for teaching. This year, I could claim the cost of my iPad as a tax deduction, because I am using it in my workplace. The same as I brought a new computer. If I brought calculators, I could do that. If you were a trades person and you brought tools, you could add that up, and that would be a tax deduction. You'll take that off your total income. Uniforms, if you're a chef and you had uniforms, or you had to get certain work boots, like for your work environment, that the company isn't paying for. Why would you want to do that? Why would you want to add up all the money that you spend to earn your income? Well, the main reason is so that you don't get taxed on it. So what you actually get taxed on is what's called your taxable income. And your taxable income is your gross income minus your tax deductions, or the money you spent to earn your income. So the money you spent to earn your income. So you get your taxable income and you get your gross income and you add up all the money you spent and you take that off that money. Why that is an advantage to you, or why you would want to do that, is because you don't want to get taxed on the money that you spend to earn your income. Okay, you're allowed to take it off. So you actually, when you work out your tax from the tax table, it will be a reduced amount. Therefore, your tax will be reduced that you pay. If you don't take this off, then you're going to end up paying more tax. So we're just going to use a tax table to calculate the tax. And I'm just going to give you an example on this. So here's an example on this. So if you're looking at this, you earn $84,000, that's your annual salary. Annual means for 1 year. And then your total tax deductions, well, that's $180. Now what we've got to do is work out the taxable income. So to work out your taxable income, the first step you have to do is you have to get your gross income, which is $84,000. And then you take your tax deductions, and your tax deductions are, now I've got 180, I'm just going to change that. I thought I did have a 1,800. So 1,800, that's probably a more reasonable claim. That's for all the money you spent to earn your income. And then what you do is to work out the taxable income. The taxable income is just your gross income minus the tax deductions. So you have to take the tax deductions away. And then when you work that out, so that's 84,000, take away 1,800. So you go 84,000 minus 1,800, you end up with 82,200. So that 82,200, that's your taxable income, and that's what you calculate your tax on. So now you go to the tax table. Now 82,200, which bracket is that in? So if you look at that, which bracket is that actually in? Well, that would be in, so 82,000, let's see, 82,000, that will be in this bracket here. So it's in the second last one. Okay, so when you're doing this, you always start at the last one. You take away the last amount, which is 80,000, so 82,200, take away 80,000. So you go 82,200, take away 80,000, and you end up with 2,200. And then you times the 0.37, because that's the one in the middle. It's in cents, so you've got to put a decimal point in front. So 0.37 times 2200 is $814. And then see how it says plus? So you times the middle plus the last one, okay? And you go backwards, work backwards, because that will help with the order of operation. So you go 17547. So you go plus 17547. So your tax is 18,361. And that will be your tax payable on the taxable income after the tax deductions are taken away.